Hi, I'm Sam Slater from Fund Caliber, and today I've been joined by Yoram Lustig, who's Head of Multi-Asset Solutions at Rowe Price. Hi, Yoram.
Hi, Sam. How are you?
Very well, thank you. You're going to cover all things inflation for us, so I thought perhaps we'd start with US inflation and why a UK investor needs to even be thinking about it.
Well, I think first I would say that UK investors should be global investors, so they should be thinking about what happens overseas, not only about what is happening in the UK. Then I would say that I wouldn't be concerned about US inflation at the moment too much. I wouldn't lose sleep because of that. But I would keep a close eye on US inflation because it could become a bigger risk. That's one thing. Now, 3 reasons why UK investors should think about US inflation. One is that our world is interconnected. What happens in the US impacts what happens in the UK. So inflation in the US can cause inflation in the UK. For example, if the US consumer, which is the most powerful economic force in the world, consumes a lot, there will be more demand for global goods, and that's inflationary not only for the US but elsewhere. Also, if the US consumes a lot and demands a lot, it puts more pressure on already stretched supply chains. So that could be inflationary. And also, the UK, we import a lot of goods from the US. And if the prices of goods in the US rises, that's importing inflation into the UK. By the way, the US is our 3rd biggest importing partner after Germany and China. So we import a lot of stuff from the US. So that's one reason why we should keep an eye on US inflation, because it can impact UK inflation. The second reason is that everyone these days watch very carefully what the Federal Reserve in the US does, the central bank in the US. Because if inflation in the US is persistently high and the Fed starts to talk about hiking interest rates in the UK or tapering the asset purchase program of the Fed. So the Fed every month buys 120 billion of US bonds and other assets. Tapering means that the Fed will start reducing the amount it buys every month. If the Fed signals that it's going to hike rates sooner than expected, or to start tapering its asset purchase program, that's going to impact all capital markets around the world, in the UK, elsewhere. So that's another reason to watch US inflation. And the third reason is that if you are a UK investor, you should invest in US assets. If you have a global equity portfolio, US equities is about 60% of the global equity market. So you should include US equities in your equity portfolio. And if you look at the global bond market, US bonds are roughly almost 40% of the global bond market. So you should also consider to include some US bonds in your portfolio. And there are many reasons to do that. But if you are a global investor, and you have US assets, you should be keeping an eye on US inflation, because it can impact the value of your US assets, and also it can impact the value of the US dollar, because high inflation may cause the dollar to depreciate. So because everything is connected, US inflation is important for everyone.
And just thinking about other areas of the world, so US inflation at the moment is 5%. We've got about 2% here in the UK. Some people are saying that Asia's already peaked in terms of inflation. So within the other assets of your portfolio, how do you kind of factor all that in?
Yeah, so that's a good question. So first, I agree that inflation in Asia may have peaked. One reason is that now we see a bit more of related restrictions in Asia, unfortunately. So that could dampen demand in Asia and cause some easing of inflation in Asia. Another reason is that some countries in Asia, it seems like they have peaked in terms of their economic growth. If you look at China, there is one measure I like to look or keep an eye on very closely, which is the Purchasing Managers Index, PMIs. The PMIs come out every month, and they are based on surveys of purchasing managers in companies. And the PMIs are very good indication for the trajectory of the economy. And the latest reading in China is to 50.6. Above 50, it still means that the economy is expected to accelerate, but it's slowing down. It's actually the lowest PMI in China for 14 months. So it seems like China economy accelerated a lot after we reopened. And now it's starting to slow down a bit. And of course, China is the second biggest economy. It impacts commodity prices. It manufactures goods for everyone. So it's very important what happens in China. So it seems like inflation in Asia is indeed easing maybe. Then when investing globally, we need to consider pretty much what happens everywhere in the world. So one consideration of why UK investors should consider inflation in Asia and elsewhere is that when we make decisions about managing global portfolios, we need to look at the macroeconomic backdrop for different regions. So we don't just focus on what happens in the UK. It's important what happens in Europe, the US, Japan, China, because we are managing global portfolios. And as we discussed before, what happens in China impacts what happens elsewhere and in the UK. So that's one reason.
And a little bit of inflation's a good thing generally. But I mean, my parents will remember inflation in the 1970s hitting sort of, 20%. And I can remember even in the late 80s, it hit about 10%. So what happens if we do end up getting inflation in the system? It becomes hyperinflation. How can you invest through that kind of environment?
So that's a good question. First, I don't think inflation will go back to the levels we saw in the 1970s and 1980s. I think the world has changed quite a lot since then. So there are a lot of secular deflationary forces. So what I think is happening is instead of inflation being up here and oscillating, it dropped here, and now it oscillates around this level. So now, of course, it's probably at the peak of the new level, but the new level of inflation is much lower than it was in the 1970s. So I wouldn't worry that inflation would go back to the levels of the 1970s. Now, having said that, hyperinflation is a risk. It's a risk because first, it can cause both stocks and bonds to fall together, and then diversification is out of the window. So that's one of the fears we have in multi-asset investing, because the whole thing about multi-asset investing is that you invest in stocks, you invest in bonds for the diversification. But if inflation rises too much, you get no diversification. The second risk is that even if we have a hint of hyperinflation coming, as I said before, if central banks around the world think they must act to prevent rising inflation, that by itself is a risk, because that could derail the equity bull market. So how do you prepare for the possibility of hyperinflation? So even though it's at the moment, it's a low risk scenario or low probability scenario, because if inflation rises, central banks will do something about it. Of course, it's not going to be good news, but there are ways. The way to protect portfolios against hyperinflation is to include some asset classes that should do well if inflation rises. One asset class is inflation-linked gilts. this asset class basically will hedge inflation if it goes above expectations. The problem with inflation-linked gilts is that they are very expensive, and if we don't have a very high inflation, you should expect to make losses on your inflation-linked gilt. So it's not the best asset class, but it's a good way to hedge inflation. Also, it's liquid. It's not a problem to buy it. Other ways to do it is in a bit more indirect way. So investing in asset classes that should do well if inflation continues to rise. So for example, some sectors in equities, which are mostly on the value side as opposed to the growth side of the equity market, should do well if inflation rises. For example, financials, energy. So these are two sectors that should benefit from economic recovery, rising rates, and rising inflation. Another example is if you buy more traditional retailers. So during the pandemic, we all did everything remotely. So technology was very much in demand. Now, if we ease the lockdowns, we'll go back to physical stores, and maybe one day we'll be able to try clothes in a shop. Not that I'm missing it, but I know some people who do. That's so you can find some sectors in equity markets that should benefit from higher inflation, or small capitalization stocks, for example. That's another example. These companies can benefit if we have a acceleration in the economy. Then other assets on the fixed income side that have relatively short duration and high yields, they can do better than other assets during inflationary periods. So, for example, global high-yield bonds or emerging market debt. These are asset classes that relatively they have shorter duration than gilts, for example. So they pay higher coupons and their maturity is shorter than most gilts. So you have less sensitivity to rising interest rates and inflation. If you do have a portfolio, what I would do, I would keep it diversified. So first, invest globally, keep it diversified between equities and bonds, and then within the equities and within the bonds, try to find asset classes that should do well if inflation rises.
That's great. Thank you very much.
No problem. Thank you.
If you'd like to find out more about T. Rowe Price's funds, please go to fundcalibre.com.